Investing in the stock market, just like any other investment, comes with risks and rewards. To obtain the most rewards, one must have the right knowledge and information. A smart investor uses this knowledge in choosing the right stocks and shares to invest in. If you want to invest in the stock market but you are a newbie in investing, then there are a couple of things you must know before you start. Knowing this will help you in navigating the stock market and will ultimately determine your success. I can tell you, it is always better to go to war fully prepared so as not to lose. For today, we shall examine the stock market in general and look at how it developed throughout the years. Let me tell you, as a new investor, this is the video you wouldn't want to miss if you want to be successful in stock investing. Now let's get right into the video. Make sure to watch this video to the end if you want to know why stock prices fluctuate and the don'ts and must-knows in stock investing. Understanding what is the stock market. Britannica.com defines the stock market as the organized market for the sale and purchase of shares and stocks. The purchase and selling are done through exchanges and over-the-market transactions and must operate in compliance with certain defined regulations. Each country can establish and operate several stock trading venues where the transactions can take place. As long as the participants or traders are compliant with the regulations, then they can trade as long as they want. The definition of key terms. 1. Stock market and stock exchange. Some view the stock market and stock exchange as having the same meaning. However, to properly define their differences, it's imperative to understand that the stock exchange is a product of the stock market. It is not identical to the stock market itself. Let's take, for example, a certain Mr. Tony who is into investing. When he tells us that he trades in the stock market, what he means is that he buys stocks through a certain exchange platform. These platforms make up the entire stock market. In the US, many stock exchange platforms are operating. The biggest, however, are the New York Stock Exchange, or NYSE, NASDAQ, and the Chicago Board Options Exchange, or CBOE. All of them comprise the US stock market as a whole. Outside the US, there are also several stock exchanges in the market. We have the Shanghai Stock Exchange in China, the Japan Exchange Group in Japan, the LSE Group in the UK, and the BSE India Limited in India. There are several more in different countries. To put it simply, stock markets are venues where the public can buy and sell shares or stocks. With the advancement in technology, it is now even easier for these exchanges to happen. Today, you can now even buy and sell stocks online. 2. Stocks or shares. A stock is a form of security that indicates that the holder has proportionate ownership in the issuing corporation. Such ownership sometimes gives the holder the right to vote during the company's meetings. Most importantly, it also gives the holder the right to receive proportionate income from the corporation, which is called dividends. These dividends are paid either quarterly, biannually, or annually. To put it simply, if you are a stock or shareholder of that corporation, you have the right over a portion of that corporation, but your ownership is directly proportional to the percentage you own. Hence, if you own 500,000 shares in a corporation with total outstanding shares of 2 million, then it means you own a 25% stake in that company. Take note, however, that it depends on the total outstanding shares that the corporation has, and some have billions. The development of the stock market. Centuries ago, the stock market was not organized and regulated just like how it is now. It took time to grow the market. The emergence of the first stock market took place in Europe in the 16th and 17th centuries. It was in the port cities of Amsterdam, London, and Antwerp that trading began. But it was more on bond exchanges and only a few companies participated. It was not until the 18th century that signified the start of the American stock market. The first stock exchange is the Philadelphia Stock Exchange, or PHLX. Later on, 24 New York stockbrokers also gathered under a buttonwood tree on Wall Street to sign the Buttonwood Agreement in 1792. It is the founding document of what is now the New York Stock Exchange, or NYSE. The agreement organized securities and allowed the trading of equity shares in the city. As technology and civilization advanced, more regulations were also put in place in the shared market. Many other stock exchanges also emerged. Technology allowed the shift of exchanges from centers to the internet. Traders can now buy and sell stocks even in the comfort of their own homes. The playing field is now leveled and has become more liquid. It is now more accessible to everyone who wants to trade. The law of supply and demand. There are many ways to determine the prices of shares in the stock market. The most common is the auctioning process, where those who buy and those who sell would have to place their bids and offers. Now, what is a bid and what is an offer? A bid refers to the price at which a person wishes to buy the stock. Offer, on the other hand, is the price at which the person selling wishes to sell. This is otherwise known as ask. Both the buyer and the seller should agree to the price for trade to take place. Take note that changes in share prices happen over time due to volumes of transactions. The function of the stock exchange is to regulate these transactions. Just like any other economic activity, the law of demand and supply is a major factor in the stock market. If more investors are buying stocks of a certain company, the price of that stock will increase. Similarly, if more investors sell stocks of a certain company, the prices decrease. But let me ask you, what will happen if there are too many buyers instead of sellers? Buyers will of course raise their bidding price to gain an advantage. Now look at it the other way. What will happen when there are too many sellers instead of buyers? Most likely, the buyers will lower their bidding price. The law of supply and demand is clearly imperative in determining the price of the stocks. What you must avoid in stock investing. 1. Being emotionally attached. A big no-no is investing in a company simply because you like that company. I know someone, Mr. Steven. He studied in a private school where he was trained in entrepreneurship. Later on, he indeed became a successful entrepreneur and acquired massive wealth. When he retired, he bought the school as an investment. He didn't even bother to look through the records. He put all his money into that school because he was attached to it. Do you know what happened next? Turned out the school was deep in debt. Mr. Steven lost all his money. What was supposedly an asset turned into a liability. Mr. Steven was in a financial mess because of his attachment to the school. If this happened to Mr. Steven, sadly, this also happened to many people investing in the stock market. Some individuals buy the stocks simply because they have past encounters with the firm or that someone they knew highly recommended it. This can be dangerous. If you want to invest in the stock market, you are better off leaving your emotional attachments behind. 2. Investing randomly. Buying stocks of a company you don't know is like gambling. Unfortunately, most people do this. Ridiculous as it sounds, some people just do it for the sake of investing. They invest without actually looking at where and what they are investing in. If you want to invest in the stock market, you must focus your attention on the companies with a good track record. You must also consider the management and the company practices. You must check these because some companies may have a bad reputation or have legal troubles. This is a risk because this may leave the company vulnerable. If you are investing in these companies, you are gambling away your money. In buying a stock, make sure you've done your research. Do a background check. Know the capacity of the firm. And always remember that you are investing your money not to lose it, but to multiply it. What you should do in stock investing. 1. Aim for a diversified investment portfolio. A wise investor does not put all his eggs in one basket. You must spread your investment across the stock market. By doing proper research, you can find several large, medium, and small-level listed companies that you can invest in. Spreading your investments will help you minimize the effects of fluctuations in the market. There are times that the performance of some companies plummets while others go up. Diversifying will serve as a backup for you in case anything happens. 2. Aim for long-term investment. Long-term investment means holding your stocks and shares for 10 years or more. If you are not prepared to wait this long, then the stock market may not be for you. If you want immediate gain, you might fall into the trap of emotions causing you to lose money in stock investing. Always remember that the emotions of fear and greed are two of the main causes why people lose money. Fear pushes people to sell when the stock prices go down, while greed pushes people to buy when the stock prices are going up. Always remember that stock prices fluctuate. It goes up and down. If you've done your research and you've invested in the right company, then your money will be safe in the long run. A long-term investment will always yield great returns regardless of the fluctuations encountered along the way. Now you know what you must remember and do before investing in the stock market. Thank you very much for watching. If you like what you've watched, stay tuned for more videos. Feel free to comment down below your requests and questions. We'll be happy to read them. Bye, financial buddies!